Welcome to Illuminati Silver. We tell the truth about silver. Today is Friday the 11th of August 2023 and we're going to take a brief look at the CPI figures as they were announced by the United States yesterday and their impact on gold and silver prices, and also what this could mean for interest rates moving forward. We've produced a similar video on our channel Finances Do Matter and we've placed a link to that below. Well, in the meantime, let's take a look on this channel as to the impact of CPI. Okay, in last week's update we did say watch out for CPI figures on Thursday as they could have a reasonable effect on the market. And interestingly, they have, but not perhaps necessarily in the way that we had expected. Would have expected to have seen quite a significant rise in the gold and silver price, and we did initially. Not significant, but a rise, but they have since fallen back. And part of the reason for that is that although the CPI figures were a repetition of the previous month, and I'll show you in a moment, the markets realize that the underlying inflation rate, though slowing down, is not really reversing sufficiently fast enough to prevent another rate rise later in the year. Let's take a quick look at what happened to CPI. You can see for July, the CPI index is 0.2% as per the previous month and as per expectations, and core CPI similarly. And what this essentially means is that CPI year over year is now at 3.2% and core CPI year over year is at 4.7%. Some distance nevertheless away from the 2% target. And later today we have the producer price index, which will be important but by no means critical. Okay, now there's some interesting comments made by Bloomberg yesterday, with a few people really stating that they're relatively confident that we may see another interest rate rise before the end of 2023, and that the central bank should not be patting itself on the back quite yet, believing that inflation has been combated. And that's the view that I take. I think it's too early, and I think another 0.25% rate rise may very well be necessary. And frankly, it would be better if it comes in now rather than later. Let's look what Bloomberg had to say. Bloomberg report yesterday, Federal Reserve policymakers are increasingly likely to leave interest rates unchanged at their next meeting after fresh evidence of easing inflation. But they'll be careful to strike a tone that their job isn't done yet. Now, the background to this is that yesterday we had the CPI figures and core consumer price index, which excludes food and energy, rose by 0.2% for a second month running. That marked the smallest back-to-back gain in more than 2 years. The data, though, came in largely as expected. And it's good news. This, according to Federal Reserve Bank of San Francisco President Mary Daly said in an interview. It's not a data point that says victory is ours. There's still more work to do, she says. And the Fed is fully committed to bringing back inflation down to 2%. Officials are divided where to go from here. You have some wanting to raise rates, and you have others who think perhaps the Federal Reserve should pause momentarily. In June, the Fed held the federal funds rate steady for the first time since it started raising rates in March 2022, but did estimate 2 more increases this year. We had the first last month. The question, of course, is when will the second one appear? Now, Fed Chair Jerome Powell will be speaking at the Fed September meeting at the Jackson Hole Conference later this month. And he's not likely to suddenly declare victory, according to this report. Now, Derek Tang, who's an economist with LH Meyer, said that the Fed does not need to hike in September, pleasing the doves who want no more tightening from here on out. Now, the FOMC of the Federal Reserve will be meeting again on the 19th to the 20th of September. And there will be another CPI report before then. And that will be the critical report to guide us as to whether we can expect to see an interest rate rise again later this year, or whether perhaps they are now done. Now, Neil Duter, head of economics at Renaissance Market Research, has said the economy is growing above trend. I don't think the Fed has done enough. There is a risk that the Fed is patting itself on the back by the end of the year, only to watch inflation potentially turn back up. And I agree with him. Let's now take a quick look at the gold and silver markets and equity markets, which to some degree were a little disappointing and rather subdued. If we take a quick look at the gold price, it's currently $1,918. It's down from the opening at the start of the week of $1,943. So we're looking at about $25 down. We can see here that prior to yesterday's CPI announcement, and perhaps just about during it, we could see gold prices rise, but then has since fallen back. Not tremendously, but nevertheless, one would have expected, if this is the end of the interest rate rise scenario, one would have expected this figure to continue back up and get close to Friday's close or Monday's opening. Silver, similarly, in that silver is currently $22.77. Remember, it closed on Friday at $23.64, so it's some 87 cents off that close. And again, but less marked, we can see that the silver price here did actually go up on Thursday and has dipped slightly into today. Equities yesterday were marginally up in the United States, but today we can see that the markets are down in the UK and throughout Europe. Now, tomorrow in our weekly update, I will of course be providing more information and our prediction for gold and silver prices, particularly next week. But that said, today we've had an announcement in the UK that GDP was higher than anticipated. And whilst that might create a degree of euphoria, unfortunately it will also mean that interest rates may still continue to rise, as it's a sign that inflation is not as yet combated. And we've seen sterling actually strengthen a little against the US dollar, but the US dollar is still holding up well above the 102 index, but I'll cover more of that tomorrow. Equity markets are being slightly adversely affected because of announcements coming out of China about local government debt being far higher than anticipated, and questions in some cases as whether they will actually be able to repay that debt. Don't miss tomorrow's update. Thank you for watching. Please give us a thumbs up, subscribe, press the bell sign, and we'll see you soon.